welcome to TradingHD, and yeah, let's dive straight in and see where we are in the world right now. Before we do that, just a quick disclaimer and risk disclosure, which I have to every time. The information contained within this presentation is intended for educational and illustrative purposes only and does not constitute investment advice. Do not make any investment decisions or other decisions based on the material presented. We cannot be held responsible for your trading results. For more information, please visit www.tradinghd.com. Okay, so that's out of the way. Let's talk about what has actually been one of the most interesting, fascinating, whichever word is not enough to describe the beginning of this year. Before I do that, one quick slide again, just to show you who I am for those who are here for the first time. I've been a hedge fund broker for many years and long-only investor since the early 90s. I've dealt in every equity market in the world. I started out in emerging markets and have been covering pretty much all global markets for many years now. And I'm doing these webinars to help share some of the ways in which I look at the markets for some of the biggest hedge funds in the world, to try and figure out where they should be going long, where they should be going short, and try to see what are the most identifiable trends on both sides. Before also I say that, I have an online course which I would strongly recommend for those who like what they hear in the webinar today to invest some time in getting behind the methodology, which is available on TradingHD's website. It's titled Begin Using Charts Like Professionals. And it's really my life's work, which I try to sort of encapsulate in an hour and a half, which I think you will enjoy. So take a look at that when you get a minute. Just a little word of encouragement on my work with Lex, who has been a client since he runs a hedge fund, and I've known him well. And it's great that Lex has some nice things to say about what we do here. So let's dive straight into the first chart that we spoke about in every webinar, which is, of course, very exciting for everybody, which is what happens to the S&P. Now, I have shown you this chart before, so I wanted to show you exactly what we said in the last webinar was that price, as you can see in the red oval over here, was starting to fail to make new highs. And the RSI had started to fail at 60. So for those of you who have seen my course online, I pay a lot of attention to RSI failures at the level of 60. On the monthly chart of the S&P, you can see a dramatic failure. My cursor is pointing to it right now in the year 2000. Once we broke through the 60 level, we started a big bear market. The same thing happened in 2007. Once we broke through the 60 level, we started a big bear market. This time, we broke through the 60 level in 2015. But the momentum of the market was so strong that after the big pullback in August, we tried to rally all the way up to the highs again. And once we got to the highs, we could not make new highs. And this is what I had warned in my previous webinar. But what happens to the S&P if we fail at 60? And that's exactly what happened in December and January this year. So if you were following my webinar of October, November, and December, you would have in real time seen the setup that the S&P was giving around here from the RSI. And the break has been so severe from the peak after a period of distribution for almost 1.5 years. In fact, from middle of 2013, all of 2014, and most of 2015, the S&P didn't really go anywhere. We've now curled over from a lower top at an RSI failure of 60. So had you been following this webinar in real time, you would be absolutely on top of this right now. Let's look at the next chart. This is the same monthly chart now shown as a weekly closing price chart. And as you can see, through my cursor, I will describe to you how the RSI between 2013 and 2014 was consistently above 60. When you're consistently above 60, all pullbacks are to be bought. This is a moving average, which again I describe in my course material as an important moving average for me, which is the 45-period exponential moving average. You can see all of 2015 we could never get above the 60 reading. We went sideways on the S&P. Then we had a big crash in August last year, and at the level of 40, we made a bottom, and we recovered the 40 RSI again. Once the 40 RSI was recovered, it was fairly obvious to all our clients, including ourselves, that we were going to go back and retest the highs again. And this is when we started to do our first webinar and say to people, watch out, if the S&P is unable to take the level of 60 out, as you can see, 1, 2, 3 failed attempts to take out 60. This decline was no surprise to any of you or to any of our clients. So we've been massively short the S&P from the end of December. Let's look at the second most important index after the NASDAQ, after the S&P, which is the NASDAQ. And look what's happening in the NASDAQ. In the year 2000, from a very overbought reading of the RSI, we came to 60. And then we had a rally attempt that failed to make a new high. Once this low was broken, we started a big bear market. And the bear market started with an RSI reading of 60. Now, what is happening? We have a very overbought NASDAQ that came to the same level as 60. Can you see this? From 2000 and 2015. Made a rally attempt, made a new high, and now we've come back very sharply lower again, leaving behind what I call a false break of the 2000 peak. This does not mean that the NASDAQ is a clear short yet, because in many ways, the NASDAQ has only just broken 60 for the first time. So whilst this pullback looks like it has got more to go, we would not necessarily be shorting NASDAQ as aggressively as we would on the S&P. And this is another reason why we are a little bit more reluctant to short the NASDAQ, because the NASDAQ for the first time, actually for the second time, after 2015 is coming back to the RSI reading of 40 again. So there will be a period of some consolidation on the NASDAQ here, even though it is very discouragingly broken beneath a weekly close of 2015. So it's very important that you follow prices closely from here for the rest of the quarter to see whether we can recover this price low again. Now here is something which is very crucial to a long-term understanding of what is happening to the U.S. economy. So we know that the S&P is weak, and we know that it is a market that you want to be short rather than long. But what is the long-term chart of the U.S. 10-year telling us? It's telling us that interest rates are likely heading lower. The long-term interest rates are likely heading lower because we have consistently failed to take out this trend line. And this time, the RSI failure is actually happening at an even lower reading than 60. Now, if we start to make lower lows over here, it would be a very strong signal that the U.S. economy is really slowing down hard. So whilst most of the hedge fund community thinks that rates are going higher, charts are pointing towards long-term interest rates going lower. That would be quite deflationary. There is no indication on this chart to us that this thing is about to break to the upside. It's more likely aligned to the downside. Let's look at the next very important indicator of global deflation or inflation, which is the US dollar. The dollar has taken out a major resistance line that comes from the early 1980s, mid-1980s. This line has been broken to the upside. What does this mean? This means that the demand for dollars is growing in the world. And if the demand for dollars is growing in the world, that is an intensely deflationary signal for the world. Because when the dollar advances, emerging markets suffer. When emerging markets suffer, a lot of the European economies that are linked to emerging markets suffer. And a lot of U.S. companies sell their stuff to emerging markets. So as EM currencies weaken against the dollar, that is generally bad for the world.